guys, in this short video I want to talk about how to manage risk properly using the risk to reward tool to determine position sizing. So this is the most important part of trading. If there's any one part of trading that you need to master, it is this right here. Because before you ever get into a trade, you need to plan out the trade. You need to know where you're going to get in, where your stop loss is going to be, and where your take profit is going to be. And so the way that I do that is I'm just going to do a mock-up setup right here. It's a very typical setup that I would be looking for. We're looking at an internal retrace. This is a fib retracement tool, and we're looking from that swing low to that swing high. We're looking at potential reactions, or the 618 and the point 0.5. And so in this scenario, I have my strategy that I'm looking for. I know where my entry is. Now, my stop loss is normally defined by a fib level, and so I'll have the 707 and 786 on here. So for me, the risk to reward tool is right here. So if you come down on your toolbar on TradingView, go down to here and you'll see you have one for a long position, one for a short position. This is going to be a long position, so I'll make sure I click that. I also have it on my favorites up here on this toolbar across the top. You can see I have my long position there. If I select that and I put that at my entry, let's say that I want to get in between the 0.5 and the 618. So my entry will be halfway in between the 0.5 and 618 because that's high probability for us to get support on an internal retrace. And then I want my stop loss to be below either the 707 or the 786. This is just one strategy that you can use for determining entry and stop loss and a take profit. And normally I would do like a 1-to-1 risk to reward. And so when you do that, you can move this green portion right here up until this number right here equals 1. And so when that equals 1, that's close enough, it's 1.01, that means that you have a 1-to-1 risk to reward. And 1-to-1 risk to reward means that you have to be right 50% of the time or more, because obviously your winner is going to be just as big as if it was a loser. You see how the red region is just as big of a percentage in price as this green region? That's a 1-to-1. That means that a winner would be 0.74% profit here. A loser would be 0.73% loss. So that's a 1-to-1. You have to be right more than 50% of the time because the winner equals the loser. Now, obviously, if you tighten up your stop loss to where you get a higher risk to reward, 1.5-to-1, now you don't have to be right 50% of the time. Now you might only have to be right 40% of the time. So, and if you tighten it up even more to a 2-to-1, with a 2-to-1 risk to reward, you only have to be right about 33% of the time. So you can see how your win rate changes with how you have your stop loss set. Now the part that I want to talk about here is when you're using this risk to reward tool. So in my case, I would have the stop loss at the 786. It gives me roughly a 1-to-1 risk to reward with my take profit up here. Obviously this take profit is arbitrary, so that's based off of this distance between entry and stop loss. I just basically arbitrarily put that to where it's the same as the distance between entry and stop, so it does give me that 1-to-1 risk to reward because I know I should be right more than 50% of the time on this setup based on my experience. So that's why I'm setting it up like this. Now the important part here is the position sizing. So let's say that I'm willing to risk 1% of my account balance on a loss. So if I have, let me just write this out. So let's say I have 100K trading account, and I'm willing to risk 1% per trade. So 1% per trade for me for a 100K trading account, that means that I can lose $1,000 per trade without going against my risk management principles. And so the way that we do that is, you see how in price you can ignore this green region. We're not worried about that data right there. We're only worried about where my entry is and where my stop loss placement is and what that percentage is. So when you have this set up and you have that percentage at 0.72%, that means that if I did my 100K trading account balance for this trade and it went to my stop loss, I would lose 0.72% of my 100K trading account. But we're okay risking 1%, and this is not 1%, that's 0.72. So what we need to do is the math here would be take 0.72, or take 1%, which you're willing to risk, and divide it by 0.72%, and that should equal a factor. It basically gives you a factor, what you can multiply by your account balance, and so that equals 1.38. So that is a multiplier. That 1.38 multiplier is what you can multiply by your account balance to get your position size for this trade. So our position size would be would equal our 100K trading account balance times 1.38 multiplier. I don't know if I spelled that right. Multiplier. And that equals $138,000. So our position size for this trade could be $138,000, and that would ensure that we lose 1% in case of stop loss. So this is how you set up every single trade. And so the reason for doing this is so that every single trade you have to calculate your position size, because every trade's a little different. Every trade might be a little different. Your stop loss might be like right here, and your take profit's like this. So you have a 1-to-1. You still have a 1-to-1 risk to reward, but your stop loss is now only 0.37% away from your entry. So now you have to redo your math up here. Now you'd have to come in here and say 0.37%, and that would give you a new multiplier, which would be 1 divided by 0.37. It would be 2.7. So your new multiplier is 2.7. Then you have to come in here and change this, and now you have a position size of 270K, and this allows you to risk 1% of your account balance of 100K. So every trade is always created equal by adjusting your position size on every single trade based on your risk to reward tool, how you have it set up. And so it doesn't have to be a fib or trace. We can do it could be any kind of strategy, really. I mean, let's take this for example right here. We have a nice channel that we're in right here, if I can get the trend line to work. Once we get above that channel, obviously we break out, and so one option right here is to use a risk to reward tool to get in on the break of this, or either a retest. Let's just say we get in somewhere right in here. You have your stop loss back within this channel, because if you've been in the Discord, you've seen where if we go back into a channel, normally it means we're going to gravitate to the bottom, if not be a reversal. So when you have these channel breakouts, you can have your stop loss relatively tight, and so this is more arbitrarily placed somewhere in this channel, or right below this reaction right here. If you were to get in after that reaction, you could place your stop loss rather tightly right in here. And so you can see when you do that, our stop loss is very, very close. It's only 0.12% away from our entry price. And so we don't really care. We don't really know what the target is on this. I mean, if we were doing a 1-to-1, it'd be very, very close. But with this kind of setup, you'd probably have like a trailing stop, so you could capture more of a move. But initially you could start out at 1-to-1, and as this breaks out more, you can just do a trailing stop and let your take profit kind of trail this price action up. But we don't really care about the take profit here. We're only worried about the distance between the entry, wherever our entry is, and the stop loss placement. And so based on this stop loss placement, we have a 0.12% difference in price between entry and stop loss. So using the same math that we had back here, with this same setup right here, we have a 0.12% distance between entry and stop loss in price. So we just come in here and we change this, because we want to risk 1% on this trade, and it's only 0.12% to our stop loss. So obviously we can use a lot more than what our account balance is. And so if we do 1% divided by 0.12, we get 8.33. So we can use 8.33x our account balance. And so change that to 8.33 and we get, a position size of $833,000 for this position, and still only risk 1% of our account balance if it hits our stop loss. So you can see the reasoning behind this, and obviously the closer that you can keep your stop, the bigger the position size that you can use, because the distance between the entry and stop is a lot smaller percentage. So when you divide that percentage by what you're willing to risk, it gives you a bigger multiplier. And so I hope this makes sense. I just wanted to make a short video for this because we've been talking about this in the chat today. Yeah, just let me know if this doesn't make sense. I'll make another video on it. But this is really the basics of doing this and setting up your trade so that you have the proper position sizing based on your stop loss distance from entry, so that you only lose 1% of your account balance. And obviously 1% is just a rule of thumb. On a trade like this, depending on how likely I thought it was to play out, I might only use like 1/4% of my account balance rather than 1%. So instead of using 1,000, instead of risking $1,000 on a loss, I would only risk $250 on a loss, because I'd do 1/4% of 100K. And so it just depends. The more that you trade, the more that you'll feel comfortable with using 1%, or maybe even more than 1% risk per trade. But 1% is just a rule of thumb. If it was me starting out with a strategy that I don't know that actually works, you probably want to paper trade it obviously first before using your real money. But if you're eager to just use real money, use something really small, like 1/4% rather than 1%. That way you can take a lot of losses in a row and it doesn't add up to be a very significant amount of your account balance. But yeah, so I think this was pretty much it for this video. Just let me know what you guys think in the Discord. I'll see you next time.